Breaking down how much you can expect to make in insurance in your first year is rather difficult because there's a lot of variables, right? And so rather than trying to give you an exact number of how much you can expect to make, my goal with this video is to show you the different variables that I find to be the most important in helping somebody set up realistic expectations. That way you can look at these variables as you're looking at different places, you know yourself best, and you can start to put together an estimation of how much you're actually going to make your first year in insurance. And so the first thing to realize if you are new to insurance, right, you're looking to get into insurance, is realizing that the numbers that people are posting on social media are usually not the numbers that are going into their bank account, right? Sometimes it could be as little as a quarter of that number that's posted on social media going into the actual bank account. And I'll break down with specific examples here in just a moment with numbers, why that actually happens, right? And so part of the issue with insurance, in my humble opinion, and part of the reason that 92% of agents fail their first year is simply because they don't have the right expectations coming into the opportunity, right? If you don't have the right expectations, then it is incredibly hard to have success. And so expectations are going to be everything, right? And we all know that we maybe shouldn't trust everything that we see online, right? So that's one of the first things that we need to realize. Now, a lot of times when people are looking into insurance, they tend to categorize it all as one thing. And that is the first important thing to know as you are starting to figure out how much can I expect to make that first year, is that you have to look at insurance in different segments, right? You're going to see a big difference between what products you're selling, what type of insurance it is. Like, for example, if I'm selling health insurance, Medicare, those types of insurance, that's going to pay more residually than it is going to pay upfront. Right? And so I'm generally not going to make as much the first year, but I'm building my book of business to build up that recurring revenue. I chose to sell life insurance and focus on life insurance because it pays up front really well, and then cross-sell the other products to slowly build up that recurring revenue. That way I could have a little bit of the best of both worlds. Now, as we're looking at the types of insurance that we sell, one of the bigger things that you want to look at is, am I captive or am I independent? Right? And so what I mean by that is, with a captive agency or a captive insurance company, what that means is that you agree to sell their products. You won't sell anybody else's products. You cannot be contracted to sell anybody else's products, right? And in turn for that, they will generally provide you leads and more resources with a lower commission. And so the captive model is going to be a really good fit for people that kind of want a happy medium between a corporate job and being an entrepreneur or having their own business, because they're taking certain things off of your plate, like buying your own leads, different expenses. There's usually still some expenses depending on the agency that you go to. They're just minimal, right? And so it makes it a little bit easier mentally for those people that don't want to invest into a business to just go out and earn commissions. Now, the trade-off for that is that your commissions are going to be lower, right? Because you're not taking on the risk, because they're taking on the risk, and you have next to no out-of-pocket expenses usually. You're going to have usually about half the commissions that you have in the independent model, which is why most people that are getting into insurance looking for freedom, looking to earn high six figures, end up going into the independent model. Because even though there is a little bit more risk, even though there are certain things they have to pay for, most people like that they get a lot more commission in the independent model. And so in a captive agency, generally speaking, you're going to start, and again, this can vary, right? But generally speaking, you're going to start somewhere between 40 to 60% commissions. And so what that 40 to 60% is based off of is, it's based off of the first year's annual premium. Now, sometimes people ask, how can they give such a big commission percentage, right, on this policy? And even when people are looking for life insurance, sometimes they get confused and they think that they can avoid the commission by going direct to the insurance carrier, which is not true. The rates are going to be the same regardless. Whether you go direct to them or you work with a broker or an agent, a captive agent, it doesn't really matter. The rates are always pretty much going to be the same. Now, the reason this is important to understand how they're paying the commissions is, what the insurance carriers are doing is they're using risk tables and guidelines. They have the data to know that when they acquire a customer, they're going to have an average length of time that that customer stays on the books. let's say it's 10 years. And so what the insurance companies are doing is they're saying, okay, if we have this person for 10 years, we'll give up 2 years to acquire that business. And they pay out the first year to 2 years in commissions to acquire the business because they're playing the long game and they know that the more customers they acquire, the better they will do. And that's how they grow. Right. And so that 40 to 50% or that 40 to 60% commission at a captive agency is going to be based off of the first year's annual premium. So if I have somebody that's paying $100 a month, that's $1,200 in annual premium. I'm getting, let's say, 60% of that or 50% of that for round numbers, right? I'm getting 600. Now, I'm not going to get the whole 600 up front. So the insurance carrier is going to do what they call an advance. And an advance is basically like a loan to you, right? Where they say, okay, you sold this business. We know based on the data, most of our people that start with us, they have the policy for this long. So we're going to give you your commission in good faith. The client pays that first insurance premium, and the insurance carrier is going to give you commissions based off of more than just that first month's premium, even though that's the only premium that the client has paid. And so in the captive world, generally speaking, this can vary a little bit, but generally speaking, most carriers are going to advance you somewhere between 65 to 75% of that actual 600, right? And so you start to do the math on that, and that goes a little bit lower. So all said and done, if I have 1,200 in annual premium, right, I'm really going to come away with a $400 to $500 commission generally when I'm captive. Now, usually speaking, this will again depend on the captive agency. What a lot of captive agencies will do is with that remaining 40% or 50% of commission that they didn't advance you because they're advancing that 65 to 75%. What a lot of captive agencies will do is they will put this into what they call your reserve account. And so your reserve account is basically an account that they will use to pay your chargebacks, right? So when somebody cancels, then you don't have to pay it. You don't have to worry about it, right? It just comes out of that account. Now, that is actually for the people that like the captive agencies, that is a huge benefit because, again, those are expenses that you don't have to worry about. You never have to worry about people canceling. It comes out of that reserve account. That can be a really good bonus. Now, not all captive agencies do that, but a lot of them do. And so that helps protect the carrier, and it also helps protect you from chargebacks, but there is a trade-off to that. Whereas when you're independent, right, and you get to the back end of that policy, so I get 75% of the way through the year, right? I'm 9 months through the year. Now we're caught up with the advance. The client has paid all of those commissions. I'm going to continue to get commissioned on the back 3 months of the year. I'm going to get commissioned as they pay their policy. So that starts to stack up, right? So that's the trade-off. But in the independent world, you don't have that reserve. So when somebody cancels, you have to pay it back. And so that's the trade-off. So that's how captive works. That's how you guys can start to break down the models. Essentially what it turns into is if I see somebody that's at a captive agency and they issued, let's say, 10,000 in business, it's generally going to be around $4,000 in commission in their actual bank account. Now, in the independent model, your commissions are usually going to be higher. The confusing thing about the independent model is usually in the independent model, you're a broker. So you're not selling to just one carrier. You have multiple carriers. It could be 2, it could be 20, it could be as many as you want, right? And so you have these different options that you can shop around for people, which gives you a big advantage because you can help more people that you talk to if they want your help, right? So you have a big advantage there. Like I said, the commissions are also going to be higher. The confusing thing, though, about the commissions in the independent model is going to be that a lot of places will advertise, let's say, 100% commission, which isn't necessarily entirely true either, right? There's a little bit more to it, but it's really difficult to explain. So just for sake of ease, we just say 100% commission, right? But what that usually means is it's a 100% contract rate. So if I work for a brokerage, they gave me a 100% contract. Now, depending on the carrier and depending on the product, each product will have a different commission rate. And so what that will look like is the higher risk the product is for the insurance carrier. For example, let's say like there's insurance products, life insurance products that are what we call guaranteed issue, where they ask absolutely no medical questions. Somebody can get a whole life policy. It's guaranteed issue, right? And the deal is that The insurance carrier doesn't ask any medical questions. If that person dies within the first 2 years, though, they won't get the death benefit, right? Usually the premiums will return to their family, but they won't get the death benefit. And so this is a really good fit for a lot of people that are looking for insurance and have medical problems. Now, these policies are higher risk for the insurance carrier. So let's say I'm at a 100% contract rate. Usually I'm going to get commissioned at about 50 to maybe 60% of whatever that contract rate is. And so it's going to be a lot less than what it is when I'm selling something that if the person's in perfect health, right, and they're in perfect health, it's not a big risk to the insurance carrier, they're going to give me that 100% contract rate. So if I'm looking at being independent and I'm being told that I have a 100% contract rate, generally speaking, it's going to average out to somewhere between 80 to 90%, depending on what primary carriers you're using and what the rates are on the specific products, which is going to come down into our next point, which is the next key variables, right? And so once we're done looking at captive versus independent, there are some other key variables that we need to look at, which are going to be leads, the training. We just talked about the comp structure and the difference in those two models, but also your work ethic and the time availability that you have. And so when we start, let's start with a big topic that everybody wants to talk about, which is leads, right? Whether you're captive or you're going to be independent, you need to know your lead sources, because even if I'm captive and I'm not paying for leads, the lead sources can dramatically affect my results. For example, if I'm working aged data aggregate leads, those are going to be much lower quality than leads that are new and generated via Google SEO search, right? And so where the leads are coming from is going to make a big difference. Ultimately, with leads, if you are in the independent model, what you really need to know is your cost per acquisition, right? Everybody's going to be a little bit different. Some people will prefer an inbound lead, which are going to be a lot more expensive, and some people are going to prefer to call age lead lists. Now, it doesn't really matter what leads you're calling. It matters how much does it cost you to acquire the sale and how much is your average commission from that lead type. Because if we can break it down like that, and then we look at how many sales we're getting from them, how hard we have to work for each sale, now we can backtrack and start to look at, okay, now I can have the data to actually scale and make money. And so generally what you want to see if you're selling general life or final expense is a cost per acquisition that's going to be less than 200. And that's because your average commission is generally going to be somewhere between 6 to 800, depending on where you're at, what your contract level is, and what carriers you're writing with, right? And so leads are a big variable that you want to take into consideration. If you are independent, there are going to be a couple of different ways that people look at leads. There are going to be some people that look at leads and they want to spend a lot, even though they may not be getting as much of an ROI. And the idea there is it's a little bit easier, right? And even if I have, let's say, a 50% profit margin, meaning I spend 1,000 and then I deposit 2,000 in my bank account, that's not fantastic, but it's also not bad, right? That's a pretty good return on investment. And so if I can go spend 20,000 in a month and net 20,000, I'm making 20,000 a month. Now, the dangerous side with that is it can put a lot of pressure on most people, and especially if they have a bad week or something like that. And so that is going to fit much better for people that have a high risk tolerance, right? And also have some money to invest and maybe some runway, because there is going to be a learning curve, right? And then you have the opposite, where people want to spend as little as possible with age leads. And so you can get age leads for as little as 25 cents, depending on how aged the lead is, or probably even more affordable than that, right? And the trade-off for that is that you're going to have to work those leads a lot harder to get a sale. And generally speaking, the average commission coming from those leads is also going to be smaller because the intent is lower. And so knowing the person that you're talking to and the agency that you're looking at joining, these are questions that you have to ask them, or they have to know and be able to walk you through, so that you can start to put expectations behind how much am I actually going to make, right? And then the training is obviously very important, right? Now, I don't think that there's training that is better than that. There is training that is better than other training. That's obvious, right? But it's more about what training fits where you're at, right? Because I could have what some people might consider the best training in the world, but if I'm not ready for the best training in the world, then it won't match. So A big mistake I see a lot of people make is they will get into insurance with somebody that maybe sells a completely different way than them, and they think it's going to transfer, or maybe they've never sold before, right? The person coming on has never sold before, and they have somebody that's teaching very advanced things that can be very confusing, right? And so you have to find somebody that's going to train to where you're actually at and individualize it a little bit. And if there's no training, then that obviously is a red flag, right? And then it comes down to your work ethic, right? One of the hardest things about insurance, especially if you're coming from a corporate environment, generally speaking, if you're coming from more of an entrepreneur's environment, somewhere where you have come to be really efficient with your time, then it's a really easy transition, right? I set 8 hours aside, I work for 8 hours. One of the hardest things that I see people struggle with, though, that especially are coming from a corporate environment, is that they, in a corporate environment, we're generally rewarded for not working very much. And what I mean by that is in a corporate environment, if you finish your work early, you don't get rewarded by going home early and getting paid the same amount. Usually you get more work added to you. So we are taught to stretch our work out. And in insurance, anything that's commission only, you want to be as efficient as possible. And so when we talk about work ethic, it's not just about setting the time aside. It's about being actually being on the phones and doing money making activity during the times that you set aside, right? But there shouldn't be, if you are setting aside a full 40-hour work week and efficiently working through that 40-hour work week, then you should be just fine, right? The biggest issue that I see is that most people that set aside that 40-hour work week, they're not very efficient during that 40 hours. And so then they have to work 60, 70 hours and they feel like they're working all the time just because they're getting distracted too much during the day. Right. Now, the typical ramp up timeline, obviously you're going to continue to progress through your first year, and ideally you make more your second year than your first year, right? You continue to progress. But the timeline that I really like to focus on is the ramp up period. How fast can you expect to get to an acceptable level, right? Where it's like, okay, I can make the decision, is this working? Is this not working? Generally speaking, I like to look at that as 3 to 4 months, right? In 3 to 4 months, you have 90 days. Studies have shown that it takes 90 days to learn how to sell something new. So 90 days is a good time frame. If you're not starting to see some traction and you're starting to get some progress in that 90 to 120 days, then I would start looking for somewhere else. Right? And it might not be that you leave insurance. Maybe you continue to do insurance and you just need to find a model that fits better for you. Usually, I don't think the problem is insurance as a whole. It just depends on what team you're on, right? And different opportunities are going to fit better for different people. Like there are companies out there that buy no leads, absolutely zero leads, and you just work a warm market, you grow and you scale that way. That's going to be great if you already have a good warm market and you have a good network that you can expand and grow. If you don't have a good network and you don't have a good market, that is going to be an incredibly difficult model, and you should probably get into a model with leads. Or if you have absolutely no money, if you're broke and you try to go into the independent model, that is generally speaking very tough. Now, I've seen people succeed doing it, but it is a lot harder if you don't have money because you have to buy your own leads. That is the entire reason why I have a supplement and nutrition team, is because when people come to me looking to do insurance, if they don't have the funds available to actually do insurance yet, I wanted somewhere where I could put them and be able to train them, help them get better at sales, right? Somewhere where they could make money and come back to insurance when they're a little bit more financially stable. And it's a double bonus because I'm able to train them at the same time so that when they come over, they're more ready to sell insurance and they're already accustomed to selling the way we sell, right? They already are familiar with the languaging, and it's a very transferable sale. And so it makes it a lot easier. But I see a lot of people that try to fit a square peg into a round hole because they have absolutely no money. They invest into leads, and then that makes them really nervous because they don't realize that their risk tolerance and that stresses them out, and then they get commission breath and they don't sell. And so that's generally a very difficult environment. And so to recap, there are a lot of different factors that come in, and whatever agency you're looking at, you should be asking them, what is their cost per acquisition? What's their average commission size? What are realistic expectations to come in and do well, right? Because I don't care what sales opportunity you do. If you are new to sales and you're only working 2 hours a day, you are setting yourself up to fail if you're trying to replace your full-time income or something like that. It generally takes more time. And so it's going to depend on the agency that you're looking at, their model, where their leads are coming from, what their commission rates look like. Make sure you ask those questions. And then if you get into an opportunity and it's been 3-4 months and you don't have traction yet, that may not be your fault, right? It might just not be a good fit, which is totally fine. It's not your problem. It's not their problem. It's probably a great opportunity for the right person. And you might just not be the right person. You might need to find the person that you fit with a little bit better. And so if you guys want to learn more about working with us, if you found this video helpful, you want to learn more about working with us and how we train, then click the link in the description. And on those calls, we talk about exactly what we do. See you guys on the next one.